Why property? 70% of Australians who own their homes are owner-occupiers. That means if, let's say, as an investor, you buy a property, 7 out of 10 will walk in and buy it for themselves. It's a growing, property is a growing asset. These numbers were before Corona, that we are increasing the population on average about 400,000 a year, 200 out of that from immigration and 200 from natural growth. And that's equivalent to a new Canberra every year. However, that got stopped because of Corona, but once Corona finishes, we'll see what we can get. But I'm sure everybody's at home trying to make babies now. With property, you can invest 10% and walk in. You don't need to, you don't need $1 million. All you need is that 10% deposit and buy that property. You can reduce your tax by at least 20%. I'm going to show you some numbers. And it's a protection against inflation. If you put your $1 million in the bank today, in 5 years' time, that $1 million is not really worth $1 million. Because you can't take that $1 million and buy the same thing that you bought 5 years ago. It's called inflation, the value of money. As the governments all around the world, especially Western countries, have the ability to print money, the money that you have in the bank is becoming less useful as the days go by. So with a property, because of the Australian taxation system, you can have the tax office, the tenant, between those two plus yourself, you can actually pay down your mortgage. And I'm going to show you some numbers. So why isn't everybody doing it? We only have 30% of people who are buying property are investors, remember, and 70% are owner-occupiers. Okay, but before we look at numbers, I'm going to warn you about certain things not to do. Because I've had people go on holidays, and then they call me back when they come back from holidays, and they say, Susan, I found a house. It's right on the water. It could be in the Central Coast, and it's beautiful. I bought it. Okay? It's all right. And it's the best investment property I will ever buy. And then they get the bad tenant. Why do they get the bad tenant? Because the people who are earning income are living in cities, in capital cities, in holiday areas, like let's say Central Coast. People don't have that much money. So you end up with a bad tenant who, I've had one client there, looks like, people have problems, and, they put their hand in the walls and there was a hand-looking hole in the wall. So the clients have to pay money to fix their properties. It's all right to buy a holiday house, but you need to know in your mind if it's a holiday house or an investment property. No to student accommodation. And the reason I say no to student accommodation, like areas where it's close to universities, is because you're confined to either sell it to an investor. So you only, if and when you sell it, you're going to sell it to an investor, and investors in the market are only 30%. And it's only going to attract students. I'm not going to go and live where all the students are living. So you're confining it to within the market, out of the pool, only to students. No to property for your kids, because we've had cases like that. All these are client cases. The kids pay the rent the first couple of months. Then after that, they don't pay the rent. So then you end up with having to pay the mortgage without getting any income for it. No to old property unless it's got good land. That's a different conversation, because if it's got good size land, you can partition. You can get a duplex out of it, and you can make some money out of it within capital growth. But tax-wise, depreciation-wise, which I'll talk about it in a minute, it's not. It's not. I don't recommend it. No to property that sounds like a bargain. I had a client who called me and said, "Oh, I just found a $100,000 property in Griffiths." That was a few years back, not now. Probably regional Australia would be a great place to invest now, because a lot of people from the city are going to move to regional Australia. So that's a new conversation. But just be careful. Who even if it's $100,000, who's going to, and you're going to borrow the money, who's going to rent it? That's the main thing, because you got to get the tenant on your side as well. And no to property that increased, in value beyond financial logic. So I'll just give you an example. I had a client looked for a property in Rozelle. Rozelle is a great place, but it's not an investment property. People who would go there, it would be like for your own home. So to pay $2 million and end up with $50,000 rent does not make sense. So the return on the investment doesn't make sense unless it is for capital growth in the end. So you got to think about what kind of property you want to invest in. So how do you invest in property? The banks will lend you between 80 to 90%, depending on your circumstances and depending on your income and depending on how much cash you've got. So all these calculations get put in the software, and we work out whether people can borrow and how much they can borrow based on your income, based on the rental income that you will be receiving from the property, and also rent income. And some banks will look at your job, whether it's a secure job or not. If you're a small business owner, the calculations are completely different. But just to give you an idea, let's say if you end up with finding a $500,000 property, the minimum you need to get into the market is a 10% deposit. You can either put the cash, so $50,000 cash, to go into and buy a property, or if you own your home, you can use the equity of your home and buy the property using the equity of your home and the equity of the investment property. But all that depends on the income you're getting, your personal exertion income and the rental income. So it's an interesting calculation. We just put the stuff in the software and we'll get you the right numbers. But these are the kind of the way to get into the property market. At least 10%, whether it's equity or cash, and the bank will lend you. If the loan is over 80%, the bank will ask you to pay mortgage insurance. They will work it out, and then they can add that mortgage insurance to the loan. And that mortgage insurance is basically not to insure you, it's to insure the bank. That if you can't pay your mortgage, they will take the property and get their insurance back. Okay, so I'm going to give you two scenarios in here. With a $550,000 property, the client put $55,000 deposit and borrowed $495 from the bank. And they also paid the stamp duty on this. So they had $55 plus stamp duty. And they paid the mortgage insurance, which would have been about, say, $5,000. Now, this property, we went for the client on interest only. And you might ask, why interest only? Because in some cases, let's say if you have a mortgage on your own home, you want to pay your own home, which is not tax deductible, first. So we say to clients, if you've got mortgage on your home on your own home, let's pay that down first, and we go interest only on the investment property. It's tax deductible, don't forget. Right now, the interest rate is 3.2. You could get, some banks might give you a bit less, maybe 3.1 for an investment property, interest only. And I'm going to show you the numbers here. So the numbers here that you need to look at is your income level. And I've actually put a few scenarios. If your income is $75,000, your income is 100,000 or 150,000 or 180,000. So we want to include everybody. But you can see that even if you're on 75,000, which is the average of, most people could be on in Australia, the impact of the tax and the cash flow, even on $75,000, someone on $75,000 income versus people on higher income, it's still tax effective. Okay, so if you're on $75,000 income, the tax you would pay if you didn't have a property is $16,000. So, your employer will take the tax out and give you the net of that every month as you get paid. If you had a property like this, 550, mortgage 495, interest only at 3.2%, your tax on, at the end of the year when we do your tax returns, the tax that you would pay on your income will be 12,000, not 16, because it's tax deductible to hold an investment property. The rent coming in minus the interest on the mortgage, minus the council rates, the water rates, and minus what we call depreciation. I'll explain that in a minute. It will get you, your taxable income will reduce and you will pay tax only $12,000. That means you will get a tax refund of $4,326. If you lodge your tax return, you've got nothing to claim, you might get a couple $100 and you go, oh my God, this is good. I'm winning here. Now imagine if you end up getting $4,000 every year. Yeah. And the good news is that okay, this is where it gets complicated. With new properties, you get to claim what we call depreciation. Depreciation is the reduction in the value of the building cost and the fittings of the building. When you get an investment property, you will get what we call a quantity surveyor's report. It's done by a quantity surveyor, and that quantity surveyor is approved by the tax office to give you that report. That report will say that you can reduce and claim the depreciation of the light fittings, the carpet, the built-in wardrobes, anything that is a fixture in your home or in the apartment. You can actually claim it as you go over a maximum of about between 5 to 7 years. That's for the fittings. For the building costs, so this is the infrastructure of the building, without, just the structure outside, you can claim it over 40 years. So let's say for a 550K property, the building cost might be about 120,000. And so you could claim 2.5% of that on your tax return, but you have not paid for that as you go every year. That will impact how much tax you pay, and it will impact the cash you will get at the end of the year. Which means in this scenario, because the interest rates right now are so low, you're actually going to be positive. It means that you're going to have $3,900 in your pocket. So it's like the property doesn't cost you anything, but you will get that tax refund plus the $3,900. Yeah, we've got a massive Excel sheet. When I started it 10 years ago, I started these courses 10 years ago, I would show the numbers and people get confused. So I actually amalgamated them and added them up. But if you ever come to see me, you will get the Excel sheet. Beautiful. Now, if you're earning $100,000 and it's the same property, the tax you would pay on $100,000 is $24,000. But by holding a property that much, your tax will be 20, and so you will get that tax back, $4,300 in your tax. I know what you're thinking. Why is 75? If I'm on 75 and I'm on 100, I'm getting the same refund. When I used to do them a couple of years ago, the numbers used to be different because now the tax rate from 2021 actually has gone down. So the tax bracket now, for anyone earning between 45,000 to 120,000, you're in the same tax bracket. So that's why the tax is the same. The 150 and the 180 is also the same. Your refunds will be the same because you're going to be in the same tax bracket. They used to be different, used to be completely different. So the second tax bracket is 120 to 180, and that's 37%. Anything above 180 is 45%. If you're earning over 180, it's 45%. It's huge, isn't it? Yeah. So when we used to do them 2 years ago, the tax benefit used to be about 7. You can see as your tax rate reduces, the tax refund reduces with it. Yeah. But that means that you got money in your pocket now than what you used to get, even 12 months ago with the new tax rates that have been introduced. Okay, so this scenario, remember with this scenario, it's interest only. So I wanted to show you the good news and the bad news, I don't want to give you only the good news and then, blindly take you somewhere and then you go, but Susan, what happened here? Okay, this is if you're going on interest only, you're cash positive, you'll get your refund, and as if this property doesn't exist. Money in, money out, plus nearly $4,000 in the bank, in your bank account. But because it's interest only, what we claim, the interest calculated on your loan, we claim it in your tax return. If you flip to principal and interest, so you're paying down the mortgage as you're going, so you can choose with the banks. First of all, the interest rate changes. It's 3% right now. When you're interest only, the bank wants to charge you more. This didn't exist before, but now they do that. Yeah. So if you go principal and interest rates go down, but your cash flow changes. You will still get your tax refund. That's $4,000. You will get that. But you will be out of pocket. This is negative $9,000. If you're 75K, 100K income, or 8.5 if you're $150,000 salary or $180,000 salary. The reason you are going to be negative, this is cash negative, is because you're paying down the principal of the mortgage component, which we can't claim in your tax return. The only thing we can claim is the interest on the loan. Paying down the debt is not tax deductible. So in this scenario, your 495K loan in the first year, by the end of the first year, your loan will go down from 495 to 482. So you'll end up reducing your loan down by $13,000, get your $4,000 refund from the tax office. So after the tax, you will be negative $9,000. You're going to be paying down this debt at nearly $9,000 a year. This is what I say to everybody. If you can't save $9,000 a year, something is wrong, right? Right? That's actually under $200 a week. You gotta save. It's the only way to get ahead. Whether you save the money in the bank, which I think is the wrong way anyway, because saving the money in the bank, you are always fighting inflation. You're fighting the feds, and you're fighting, our Reserve Bank always printing money. Because the more they print money, right, the less the value of your money. Yeah. So you lock in a property, you pay down the mortgage, you diligently top up that property. That's going to be just under $800 a month, and you put that money aside and you pay down that mortgage. Within 20 years, this loan will be gone, and your 550K property would have gone in, grown in value. I can't guarantee how much it is, depends on all sorts of variables. Does that make sense?